Okay, look into this. Segment 26, valuation under customs. So we are going to cover in this segment Incoterms, determination of assessable value in case of import, and primary adjustments to FOB, secondary adjustments to FOB, then customs valuation rules in case of import and export, and rejection of declared value. So first we have various prices in international commerce, that is called as Incoterms. Ex-factory price means the price prevailing at the exporter's factory. FAS means the price prevailing at the exporter's port only before loading, that is only transportation charges will be added for ex-factory price. We get free alongside price. To this free alongside price, we need to add loading charges, then we will get the FOB price, that is a price on board, and thereafter plus freight and insurance when we add, we get the CIF price, that is the price prevailing at the time and place of importation, and post-import expenses are not part of value. How to determine the assessable value in case of import? First we need to take ex-factory price, the price at exporter's factory, add freight from factory to load port or airport, that we will get free alongside price, plus loading charges we get FOB price. But this FOB price is only as per invoice. To that FOB price we need to make primary adjustments. These primary adjustments are given as per Rule 10 sub Rule 1. First is selling commission, container cost, packing cost. These three expenses which are incurred by the importer on behalf of exporter. Then direct material, consumables, molds and dyes are intangibles, but intangibles should be procured outside India, supplied by importer to exporter either free of cost or at concessional rate. Either full cost will be included or the apportioned cost will be included. Then royalty, license fee payable for the imported product as per the condition, as per contract. So that is whenever we are importing a product, for that product, for using the product, we need to pay the royalty. That royalty also will be included. Even if the royalty is payable based on the sales also we need to include, but we need to know that at the time of import as to how much royalty we need to pay. Otherwise we cannot determine the value. And all expenses incurred by exporter and chargeable to importer when? Before import. Before import, no need to check whether it is as per condition of sale or not. After import, we need to check as a condition of sale. So after import, example, installation charges even though after import, but we need to pay as per condition of sale, so therefore we need to include. When it is before import, no need to check anything, always it will be included. Now you will get FOB price as per customs. To this FOB price as per customs, we need to do secondary adjustments. That secondary adjustments will be as per Rule 10 sub Rule 2. So two adjustments only, that is freight up to importer's port or airport and insurance up to importer's port or airport. Now you will get CIF price or assessable value under customs in case of import. Then what is the transaction value in case of import? So transaction value in case of import is the price prevailing at the time and place of importation, which is actually paid or payable. So if there is a change in contract price, consider the revised price at which goods are imported, provided that price has changed before import. Suppose if the price has changed after import, we should not consider that. The price that we actually pay should be taken. Then what are the adjustments to be made to the FOB price? First, commission, primary adjustments, commission. Commission divided into two, buying commission, selling commission. Buying commission is commission to importer's agent, which is paid by importer. It will not be included in the value. Selling commission is commission to exporter's agent, which is paid by exporter, will not be included in value. Only if the selling commission is paid to exporter's agent by the importer, then it should be included in the value. The other name for this selling commission is local agent's commission. Then next, we need to see here second point, material sent by the importer to exporter, including capital goods or intangibles. It should be included in the value, either at actual cost or apportioned cost. But these material, capital goods, intangibles are used in the manufacture of imported goods. Then other expenses before import to be included in value, after import as a condition of sale as per contract to be included. If it is as per importer request, it will not be included. Then valuation in case of imports. So secondary adjustments, assessable value in case of import is CIF price. To that CIF price, how we will arrive? FOB price plus insurance plus freight. So we need to make the adjustments. FOB price given plus adjustments as given above. Okay, and insurance actually is ascertainable, we will take actuals, not ascertainable 1.125% of FOB. Freight ascertainable, even ascertainable. If it is air freight, we will compare with 20% of FOB, whichever is lower. If it is other freight, we will take actuals. If the freight is not ascertainable, we will take 20% of FOB. And this freight shall include handling charges. But this handling charges is not at the place of import. Means unloading charges in the importer's port will not be included. Ship demurrage charges, lighterage and bar charges. These are payable by the person in charge of the conveyance if the ship is anchored at the outer space, which could not be brought to port. Ship demurrage charges, lighterage and barge. Lighterage and barge is to bring the goods from the ship to the shore. Charges incurred for transportation of goods from ship to shore. And demurrage charges. What is the treatment of demurrage charges? Demurrage charges payable or paid by importer will not be included in value because it is after import. But ship demurrage charges will be included. Then next, customs valuation when ex-factory price is given. So freight from exporting country to India is available. When it is available, we will take air freight. Air freight, we will take actual, but while taking actual, we need to take from which place to which place? From the factory to the importer's airport, or 20% of the FOB, whichever is lower, minus which is already considered in FOB, we should take out. What is already considered in FOB? From the factory gate of the exporter to the exporter's port or airport. So then loading charges in exporter's port or airport is already part of FOB. So we need to separate that. Okay. So this is the adjustment which we have seen. Suppose if it is other freight we will take actuals. So freight from exporting country to India is not available. Then in that case, we will take freight as 20% of FOB, but something which is already there in FOB which you need to take out. So usually when we take ex-factory price is, say for example $10,000, and we will take loading charges and freight up to exporter's port or airport, say that is $1,000. So therefore say $12,000, and we will be taking so $12,000 as the FOB. So this $2,000 is from the factory gate of the exporter to the load airport or port. So therefore that should also be part of FOB. So this will be taken as FOB. And to this FOB, when you take freight as 20% of FOB, got it? So freight we will take as 20% of FOB. So 20% of FOB means 12,000 into 20%, 2,400. So 12,000 into 20%, 2,400. But already 2,000 considered here. Already 2,000 considered here. So that should be reduced. 2,000 should be reduced. So effectively we need to take only $400 as the freight. And insurance, if insurance is ascertainable, say insurance is $100, we'll take that, and that's where we will get the assessable value. That is 12,000 plus 400 plus 100, that is 12,500 will be taken as the assessable value. So something which is already part of FOB that we need to reduce, because in ICA exams they will take the assumption that when you take 20%, it is from the factory gate of the exporter to the port or airport of the exporter. So it is already included in the 20%. So this adjustment we need to do only when we take 20%. When we will take 20%, in two places we will take 20%. Number one, when freight is not ascertainable, we will take 20%. Or in case of air freight, we will take actual or 20%, whichever is lower. And before that, first of all, these adjustments we need to do only when ex-factory price is given in the question. Otherwise, we don't have to do these adjustments. Then, next we have customs valuation rules in case of import, and these following sequence to be applied. First, rule 3. Rule 3 says assessable value equals to transaction value. All the above adjustments should be made, and if the customs officer have doubt about the truth or accuracy of the declared value, then they will reject it. And 4 conditions should be satisfied. It should be unrestricted sale, unconditional sale, and sale between unrelated parties, and price must be the sole consideration. Then only transaction value will be taken. Suppose if the transaction value is rejected, or if it is between related parties, or if price is not sole consideration, then in that case, rule 4, assessable value equals to transaction value of identical goods. Identical goods means what? That is also imported goods having the same physical characteristics and quality, produced in the same country and same person preferably, not compulsory. And 3 adjustments we need to make: difference in quantity, difference in transportation cost, and difference in commercial level of importation. Quantity means if I am importing 2,000, other person is importing 3,000, what if he imports 2,000? That adjustment should be made. Difference in transportation cost. I imported to Chennai port, that person imported to Mumbai port. Had he imported to Chennai port, what is the extra freight cost that should be adjusted? If I import from dealer, that person import from manufacturer. Had he imported from dealer, so extra dealer margin will be there. That adjustment we need to make. That is this difference in quantity, difference in transportation cost, difference in commercial level. Suppose if multiple comparable transactions are identified in this case, we need to take whichever is lowest. Lowest of such value should be considered. Then assessable value, suppose if that fails, identical goods fails, then we will go to similar goods. What is the difference between identical goods and similar goods? Similar goods is also imported goods, but commercially interchangeable. So means instead of a top load washing machine, we can take a front load washing machine as a comparable. That is commercially interchangeable, but it should also be produced in the same country, produced by the same person preferably. And here extra one more adjustment we need to make. Apart from quantity, transportation cost, commercial level, we need to make the extra adjustment related to material and engineering works. Here also, if there is more than one method, like more than one value, we need to take whichever is lowest. For example, we are importing a top load washing machine and there is a front load washing machine as comparable. Now we need to see the usual price difference between a top load and a front load. That adjustment we need to make. That is this. Then rule 6, when the above rules are not applicable, either you can take rule 7 or rule 8 in any order. Customs officer cannot say you to go for deductive value only. No, it's up to me. Either I can go for deductive value or I can go for computed value. Rule 7 says deductive value. Deductive value is simple. We will see the sale price in India minus all post importation expenses including customs duty we take out. Then we will get the deductive value. Computed value is we take the raw material cost and add everything up to importer's place including the freight and insurance. Then we will get the computed value. Then rule 9, assessable value is based on best judgment assessment. So that is a value determined by the customs officer. But while determining the customs officer, just randomly they cannot take. So they have to determine as to how the value has been ascertained. So that should be taken. Just the sale price in India cannot be taken as best judgment value. Sale price of the goods in domestic market of the country of exportation cannot be taken. No value shall be determined on the basis of this. Sale price of the goods for export to country other than India, cost of production, highest of two alternatives, minimum customs value, arbitrary. So these things are not required. But what you need to know is that just like that they cannot determine scientifically using the principles of valuation, they need to ascertain the value. Then valuation in case of export, simple, we will take FOB price and adjustment is not required. And in case of export also, we have valuation rules. Rule 3, assessable value equals to transaction value, but proper officer should be satisfied that the declared transaction value is genuine. And even in case of related party, transaction value may be acceptable here. But if they are rejecting, then we need to go for rule 4, transaction value of goods of like kind and quality. Like kind and quality means that is also exported goods, same physical characteristics and quality, same country and same person, okay. And adjustment, difference in quantity, difference in transportation cost, difference in commercial, here also same. If multiple transactions are found, then lowest value will be taken. Then computed value. Computed value is like our customs computed value, normally cost of production plus profit and general expenses. But in this computed value, we will not take the transportation cost. But in this computed value, they will be taking the freight and insurance. Because usually in case of import, we need to take CIF price. In case of export, we need to take FOB price. And best judgment value if that is not identifiable. And meaning of related. Meaning of related in the context of customs is same as the meaning of related in GST. Except that in customs, person holding 5%, that is two companies having common shareholder holding 5% or more becomes related. Whereas in GST, two companies having common shareholder holding 25% or more will become related. So more equity in 2% make them related instead of 25% or more in GST. Then declaration by importer. Importer should declare that the value that they have shown in the shipping bill or bill of entry is genuine, and otherwise there is a rejection of declared value. That is, proper officer can reject if there is doubt about the truth and accuracy, and in that case the value will be determined as per rules and the transaction value is not applicable. Okay, so this is a summary of valuation in short what we have discussed. Okay.